let's kick it off. Hello, everyone. Apologies, last call we had some tech issues and we could not go ahead with it, but it's a special call today. We have our Chief Investment Officer, Steen Jakobsen, joining us. He's been in Asia since the last week, traveling around our offices here. He's been to Singapore, Sydney, and now we're all in Hong Kong for our macro event here as well. And I think we thought it would be a great idea to get him also on this call so our partners and clients could kind of get his views. So Steen, I think maybe we kick it off with you sharing your insights about what you're seeing in the markets right now, back in Europe, but also now that you're here in Asia. What are you taking away from here?
Thank you, Charu. Good morning, good afternoon, everybody. It's a great pleasure and honor to be on the call. I think what we need to handicap right now is we're in a world where, as I like to say in my speeches, I have two speeches. One is that we will have a very negative intermediate future with very little upside, or we will have a very bad, extremely negative outlook with a big upside. And what I talk about here is that 12 months ago, we all talked about that the Federal Reserve will continue hiking until something breaks. I think something is broken. I think the market is breaking as we sit and talk here today. And the way we can see that is, first, the fallouts that we've seen in the equity space. Green transformation couldn't live with interest rate going higher because they were simply based on negative real rates. Now we see the banking sector in the US under real concern in terms of their return year to date, everything from the major money center banks down 15 to 35%, which is a real concern because, of course, where the banks go, the economy goes. We've had the sort of important excess return on the US economy in terms of growth, but that is slowing down very, very fast right here and now, as we see that the forward-looking gauges for employment is really showing red alert in terms of people being laid off, the so-called warn notices in the US, which is a law that constitutes that you need to pre-warn. I think it's 8 weeks before laying off more than 10 people has shot through the roof. So it's pretty clear we're at a point where the fiscal dominance, the handover that we saw from COVID, meant that the economy has been able to sustain a higher growth path for longer. It's also probably entailed that we had a higher marginal inflation rate. I think the low in this cycle in terms of interest rates were probably seen a couple of months ago. Over the course of the next 2 to 3 months, we will see that the month-over-month number will move back to 0.2, 0.3%, which equates to, of course, a number which is sitting north of 4% overall. So the new reality we live in is that the inflation rate is probably having a new floor, which is called 3, a new ceiling, which is probably called 6 inside a normal business cycle. We have a Federal Reserve and global central banks determined to be talking rhetorically. I should add that probably the right time for that was 2 years ago and not now. But they have now ended up in a situation that they are more concerned about their own integrity than they are about the functioning of the market. And that means that something is breaking. And when something is breaking, we need to look back at what has Federal Reserve done in terms of cutting rates since 98. 98 is the starting point for me, at least, because that's when Fed decided to bail out long-term credit, the big hedge fund in the US. And since then, we had this moral debacle going on where they're trying to save everything in the world by lowering interest rate and taking effectively over the short end of the market. I think we're at that point. I think the velocity of what we see in the short in the US, we see the inability of the market to agree on term premium or the sort of the validity and the integrity of the US debt. We see that the US has issued $2 trillion this year. We see that the tails in terms of the auctions are getting longer. We see that there is more fails in the bond market than we've seen in a long time. So net, this leaves us in a position where we think there is at least 50% probability that Fed will cut rates, not because the recession is coming, it is, but more likely because the more prevalent risk that they see in the marketplace is the ill functioning of it. Illiquidity is the number one priority for any central bank, but in particular for Federal Reserve, because of course they are this huge reservoir of capital to the rest of the world and the domestic market. The other part is the consumer. Do know that the U.S. consumer right now is facing his ability to use marginal credit is extremely punitive. Credit cards interest rates are in excess of 20%. Mortgage rates, as we all know, 30 years is above 8%. And car loans, which is a critical part of the sort of disposable income spent from the U.S. consumer, is at 8%. All of this is either 1.5 or 2 times what the norm is. So the ability to renew your consumption is really limited into a economic environment where we have politically the most fragmented economy. So for me, the small upside, the small downside and the small upside is based on pretend and extend. I think the most likely scenario is that the central banks will step in. They will try to control the interest rate. They will try to talk to the fact that the economy and global exterior factors are rising in terms of this impact. Of course, here, the Middle East crisis is one factor. The market right now has started pricing that risk away. I think it's a mistake, a grave mistake. 9/11 changed the world. It changed the way we see privacy. It changed the way we see property rights. But it certainly changed the world towards a narrative which is us against them. And I think that's been accentuated by the Ukraine war and now by the Middle East war. So for me, that is something you need to keep an eye on. But to make this more sort of applicable to today, this week we have 3 major events. We are waiting for Bank of Japan. I'll let Charu talk to that. We have Federal Reserve. I think the outcome from Federal Reserve is, of course, no go in terms of hiking rates, but also addressing the sort of the major concern they have for the international market and the yearly function. They're not going to say that the short end of the U.S. market is at risk, but they're going to talk to that the sort of the compounded impact on high interest rate is now hitting. And most importantly, they're going to address and talk to you directly about the fact that the level of interest rate really equates to, in Federal Reserve's interpretation, that they have done another 2 to 4 hikes into the future. So in other words, the market has done the job for them. So I don't think there'll be major surprises. But net, I do expect Fed to be more dovish than hawkish in this one. And that sort of sets up the overall sort of waiting for the next economic data point to turn over. The non-farm payroll coming later this week, of course, is critical. But net, I think it's only a matter of time before both jobless claims and the non-farm payroll will start to reflect a U.S. economy which is slowing down. So, for our money, we have been in the same position in terms of advocating overweight into the same sector since 2 years ago. And those sectors are cybersecurity, it's defense spending, unfortunately, it's logistics, it's mining and energy, and not least, it's semiconductors in that industry. If we sort of move it into a more macro world, what we're really saying is that the S&P valuation is 90% tangible assets, intangible assets, and 10% tangible. So 90% of all the valuation sits in terms of IP and similar in the US. That's an issue simply because the real economy that needs to give you clean water, energy, hospitals, educational systems, infrastructure war is coming from the real economy. So in other words, the real economy is too small for the digital green transformation and the fiscal dominance. So the way for us to sort of look at the market is to be investing in what is the solution, which is the solution is to invest in the tangible economy. And that leaves us, very clearly in a defensive mode. As I said, 2 speeches, 1 negative, 1 super negative. But the super negative one is based on that we get a price discovery. And I think to some extent we're seeing that right now. We begin to see the market questioning the bond market in the US through term premiums or high interest rate. But at the same time, we see something like gold and energy starting to come off. So let me end by quoting JP Morgan in 1912 in front of Congress. He said, gold is money, everything else is paper. And in Saxo's version 2.0 into 2023, we probably say that gold and energy is money, everything else is paper. And I think we are moving to that stage in the economic cycle where having tangible assets to put as collateral against what you want to do in terms of activity is going to be very, very important for where we are. My final point is a chart I updated this morning. It's basically a timing chart on the S&P 500. This is the number of stock in the S&P 500 trading above its 200-day moving average. As you can see, back to 2015, the Chinese devaluation, we've had lows every time we've gone below 20% to 0% in terms of the number of stocks. As we sit here today, this morning, it's at 28. So a little bit further ground to be made up to get there. And as you can see, some of the lows are, of course, not just exactly on 20, but slightly below 20. But I think it's pretty clear we are reaching a cycle where we reprice the 493 stocks in the S&P 500. A little bit of still to do in the 7, but net, we are probably in a position where we are reaching into oversold conditions. And that could, together with the fact that we think Fed is done, the ECB is done, RBA is done, and that probably is in a position where we think the market will have some kind of a relief rally. But unfortunately, the conclusion has to be that's based on my first offer on a speech, which is small downside with small upside. What we really need to get to is the big upside, and that's all about productivity and investment into this real economy. So with those words, I wish you a safe week, and thank you for having me.
Thank you, Steen, for that broad overview about everything that you're seeing in the markets. I think that's really interesting. Coming from a few points that I would kind of really focus on is that markets are starting to underprice this geopolitical risk right now. I think that's really key. What's going on, it could have huge ramifications still, and that's something I think we should continue to engage market participants with. And of course, what you said about the Fed as well, looks like the Fed is done not just for this week, but they're done for this cycle. So I think maybe we could just move on to the slides, and we could talk through that a little bit. If we look at the central banks, there are these 3 big central bank meetings that are due this week, with a host of other data to watch as well. But particularly, I think the Bank of Japan, which should be out with a decision anytime now in the next hour or so. The more they delay the decision, the more speculation builds that they're going to do something about their yield curve control policy today. But I mean, of course, not just that, there's been speculation building otherwise as well. Given where the yen has been, given where JGB yields are trending, we are now up very close to that 1% ceiling. And there was a little bit of a leak yesterday in Nikkei saying that the Bank of Japan could be considering raising that 10-year yield target further to maybe, they didn't really give a number, but it could be 1.25, 1.5% or something. So I do think that's a very costly exercise to do. They raised it to 1% last time, and they've had to still, kind of keep buying bonds there. So it is a costly one, but it is the only effective, tool that they have in the near term. If they have to kind of obviously start talking about an eventual removal of the yield curve control, or the eventual, getting away from that negative interest rate policy, it is something that they are going to wait to see the wage numbers next year from the wage negotiations that comes out in March or April. So that's a very gradual process. So I think there are several scenarios that can play out today, and accordingly, we'll have some implications for the Japanese yen as well. Particularly, the first thing is, if they just do a tweak in that 10-year JGB yield target, it is going to be, I would think that the appreciation of the yen could remain pretty measured on that because of that upward pressure in USD yen that is still coming from a higher USD, from higher US Treasury yields as well. I think the markets will continue to test the Bank of Japan for an eventual removal of that yield curve control policy. The second scenario is, of course, that if we get any clear hints about that eventual move that we have been talking about, right? So if we do get that, it could come in the form of either upward revision to inflation forecast, which could say that, this will be, if we do do see a revision in FY 2024 inflation forecast to above 2%, then this is going to be the third straight year where inflation breaches the central bank's target. So it does get harder at this point to continue to call inflation being transitory. I mean, of course, they want to see the wage pressures, but I think it will be a very clear signal that they are looking at inflation to be more sticky than earlier thought. So I think those inflation numbers could be one signal as to where the policy is moving, but otherwise, of course, obviously focus on the language in the statement as well. But again, I mean, Bank of Japan always has this ability to surprise dovish. So, I mean, of course, that's something we need to brace for as well. Overall, I would think from a Japanese yen perspective, it looks like there is some more room for the Japanese yen to weaken at this point, and especially with last week, the 150 level was breached in USD yen. So we know for sure now that's not the line in the sand for Bank of Japan to come in and intervene and stop the yen from depreciating anymore from there. So if we do see those dovish outcomes, or if I would think that we could continue to go up above 150 on USD yen, probably to 152, 155 or so. And of course, a proper recovery in the yen will have to wait for that US economic numbers to start to show some weakness, the Fed outcomes to start to be a little bit more dovish than what the market is really pricing in at this point, which is also a good segue into what to expect from the Fed this week. Obviously, I think that affects a lot of clients, probably more than Bank of Japan at this point, although I think Bank of Japan has the ability to really be the big surprise for this week. But for the Fed, certainly I know a lot of people are watching that. Steen mentioned a few points as well. The weakening consumer being the biggest reason as to why the Fed could stay on the sidelines this week. Fed Chair Powell has already continued to highlight the long and variable lags between implementing a change to policy interest rates and its effect on the real economy. Those lags will mean that they are still bracing for the weakness in the economy to come through. The consumer is, I think we've talked on previous calls as well, they're running out of savings now. So I mean, of course, we've seen very strong GDP growth numbers last week, but that's historical data. It was where the consumer had the ability to dip into the savings. But now moving forward, if you look at the forward-looking data, if you look at credit card debt, if you look at auto loan delinquencies, and other indicators are suggesting that U.S. consumer is running out of firepower here. So that's certainly one reason why the Fed would be, potentially on hold this week, and maybe even dovish, as Steen says. Also, we have seen this huge run higher in long end yields, and many Fed members have recently hinted that that could work to substitute for a rate hike. So, of course, that's something that would be a rhetoric potentially again coming out of this meeting as well, because that looks like to be the consensus view. Most of the Fed members have talked about it in the last few weeks before this quiet period ahead of the Fed meeting started. And of course, we are in the middle of these fresh geopolitical risks. What's happening in the Middle East? We've said that before. I mean, of course, the market is starting to take down some risk there, but I think hiking rates in the middle of a war does not seem to be the right thing to do for the Fed as well. I mean, of course, there's potential for an inflation shock from this, as much as oil prices are still seeing a pretty choppy move with this crisis playing out, and that's because the supply is not being seen as affected right now. But if it was to expand into a more regional kind of a conflict, then that would bring some supply worries in the oil side as well. But having said that, I mean, I would say inflation worries from the war have not really escalated so far. So again, that gives another reason for the Fed to kind of stay on pause this week. So I mean, in our view, really, the Fed is done here, not just for this meeting, but for the cycle as a whole. And the next move will likely be a rate cut. But we don't get an updated dot plot this time from the Fed. So the thinking, the Fed's thinking of when the first rate cut could really come will have to be either in the post FOMC press conference or, I think the comments that come through following the Fed meeting from the different members as well. So I think those will be the ones that really kind of prompt the market. So the market's right now pricing in the first full rate cut for July, if I'm not wrong. I think it's for July. And if the economy weakens faster than what's being priced in right now, there is a significant room for that to be brought forward as well. So I think that's something key to watch going into the next few weeks, how that happens. And then finally, there's also, there's this serious threat about what kind of a commodity impulse could come from China. And for that, we need to really watch some of the important policy meetings that are going on and are scheduled to happen in China in the next few weeks. We did get the PMIs this morning in China, and they were a little bit weaker than expected, which again goes to say that the recovery is still pretty tentative. So the focus stays on what more is being done in the property sector, in the shadow banking sector, and the likes. And those are some of the decisions that could come out of these important political meetings that we have going on in China. So that's certainly something worth watching as well over the next week or so, and probably going into November as well. And lastly, I think just to sum it up, I think this is a really important slide. I wanted to talk about how we could engage clients on positioning for any kind of an escalation in geopolitical risks. Before I cover this, I think I would also just like to remind you we have an option to take questions on this call. So Steen is here to answer questions. Also, Redmond Wong, our China strategist, is also on the call. So if you have any questions, you would probably see a box on the right hand side of your screen somewhere to pop in a question if you like. Please do that, and we'll be happy to take that at the end of this call. But yes, just summarizing the slide, as many of us have asked us in the past, is to give us some instrument names about the theme that we discuss in every call. So this one is about, of course, positioning for geopolitical risk. Gold certainly seems to be the key player here. We've seen the run higher in gold coming. On Friday it was up at $2,000 level, and even though there's been some pullback at the start of this week because Israel's efforts have been a little bit more measured than previously feared. But still, gold has held up pretty well. We're still above that 1980-85 kind of level, which is a key support zone for gold. So of course, if you're interested in gold, we have futures, we have FX options as well to trade gold. And I think that's one of the easiest ways to get exposure. But also, if you want to consider just ETFs, we have a lot of ETFs for that, GLD, DPB, some of them that I've listed here. But of course, if you just go onto the Saxo platform and search for gold ETF, you will be able to find a few more as well. So I think that's about gold. And then, like Steen said, gold and energy is really the key things to kind of consider here in this environment. And energy, commodities, he also mentioned about a lot of other themes that we are at Saxo positive on. He touched on cybersecurity, logistics. We will cover more and more of those themes in our subsequent calls as well. But I just want to focus on energy here today because that's really a key pick for us. Saxo, we do think there's of course there's a risk from geopolitics, but that's I would say, that's probably hopefully temporary. If not, also there's this structural shortage of supply in the energy markets because of years of underinvestment, and that keeps the demand supply imbalance likely in place. And so I think if you are looking to get some exposure in the energy space, of course you could consider the single stocks. There's a lot of oil players that have been paying huge dividends, huge shareholder returns. So I think I've just listed a few of them. None of this is actually investment advice, but only for kind of some inspiration if you want to go and look back into what are the options there. There's obviously also this whole renewable energy stocks. The renewable we have a renewable energy theme basket as well on the Saxo platform. I'm not sure if you have access to that. And again, I've discussed this on this call a few times before, that we have theme baskets, many theme baskets on the Saxo platform's research page, where you can go and look at the top 20 stocks in each of the themes that are fully reflective of that theme as well. So you could obviously take a look at that basket if you have access, but otherwise there's this renewable energy stocks that you could get exposure to, and also the ETFs, both in the energy as well as in the renewable space. XLE is one of the most liquid energy sector ETFs, but of course, again, there's a lot more ETF providers that provide ETFs for equipments and services, upstream or downstream, oil and gas or other fossil fuels, and also for renewable energy ETFs. So there's a whole list of options there to consider. And lastly, again, this is something that we've discussed in the past when we launched our Q4 quarterly outlook, which is titled Long bonds. But of course, there is a huge, there's a lot of, I think, opportunity right now in the bond space, given the kind of yields they are offering, and even though there are risks that yields could go high from here, but the carry that you can generate with that coupon income is able to offset the risk of those higher yields from here. So of course we are still calling for to stay in high quality and in the short end for now. And of course you could either do that directly through the bonds, through the fixed income space, but also there are again ETFs to consider for any kind of a maturity that you're looking for. For example, if you're looking for treasury short maturity, there's SHV, there's SHY. If you're looking for a super long maturity, TLT. If you're looking for corporate bonds, there's LQD. So I've listed all of those as well on the slide, and as always we will share the slides as well with you all later on. But I think that's really about it from us today. And I don't quite see any questions as of now. But of course, if you do have any questions, feel free to send them through your RMs and your other Saxo contacts. And we will be happy to answer them for you later on. And have a good day, everyone. Good week. And we'll speak to you again in 2 weeks. Thank you. Bye.